You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionFit.com.
And welcome to your bi-weekly show, The Option Block. No, I am not Mark Longo. I am trying to fill his enormous shoes. And today I have as my special guest, Mr. Andrew Giovinazzi. Andrew, how are you doing today, sir?
It is the first sunny day in Maine, in a warm day. I'm good. I want to actually try to go fishing.
Going fishing? What kind of fish do you try and fish for out there?
Right now, stripers.
Got it.
All right. Hey, Andrew.
And the tinny voice that just came into the show is none other than the great Mark Sebastian. Mr. Seabass, how are you today, sir?
I'm doing great. How are you?
Doing well, doing well. All right, well, let's start off. We got a lot to talk about today in the marketplace, and even if we don't have a lot to talk about today, I think we will have a lot to talk about what's going to be coming up tomorrow nonetheless. So I will kick it off with you, Mr. Andrew. What are you seeing right now with this past week? We have bonds coming down with the exception of today. We have markets coming down a little bit, and we have the VIX. Well, it's the VIX. What are some of your thoughts on the marketplace?
It looks a little confusing. Volatility is staying up. I don't think it really has much to do with stocks. I think it has everything to do with EU and bonds and exodus from bonds and unwinding and general unpleasantness in the bond market, as maybe everybody thinks 0% yields are not the best investment right now. I think that's causing some issues. Yeah.
I could see that. Seabass, what are some of your thoughts?
Yeah, I mean, I think what you're looking at is essentially a market where the just crowded trade after crowded trade blowing up. So first everybody's short bonds, then everybody's long, now everybody's short. They're going to get blown up down here too. Then you see the same thing in currency, the same thing in some of the precious metals and equities. It's been pretty silly, to be honest. And I'm not really a believer in that the bond rally is over. I think there's a lot of people that are still worried the Fed might do something, either in June or sometime after that, which, just isn't going to happen. But, it's been interesting. I think the real piece is the reaction on Germany. We had talked about how the spread between the Bund and the 10-year had reached really epic proportions. And that has tightened up. While the 10-year yield's gone from 1.8 to, 2.20. The Bund is the one has made almost double the move. So the spread has tightened up, but not in the 10-year rallying as I would have thought, but in the just the absolute decimation of the German Bund. Now we got some stabilization today, which is why markets rallied. And I think markets might have rallied more if we didn't have non-farm payrolls going tomorrow, which is one thing. But definitely a sell-off in volatility. A pretty decent rally in some of the tech names. The tech had been kind of the big loser the last couple of weeks, and we saw the NASDAQ really not have a terrible day today. It was, after being the biggest loser the last few days, it was the biggest winner. So what isn't shocking. And the SPOOs themselves, up small. But I think the big story was that we actually managed to rally today after, when the world was ending yesterday at 2:15 in the afternoon.
Yeah, I remember that. Somehow we seem to pull through again.
It's amazing.
Yeah, it's funny how that works. Now let's expand on the bonds a little bit. So you're thinking right now that we actually may get a little bit of so this may be a buying opportunity in the bonds, is what you're thinking from the pullback that we've been having?
Absolutely. I am, when it got down to 225, on my SIBO TV show, Track the Trade, I was saying I set up a bullish trade on thestreet.com where I write. I set up a bullish trade and an option pit. I absolutely encouraged, I talked about a setup for a bullish trade in TLT as well. I'm very bullish the bonds. And Jared Woodard, my sometimes co-host on Volatility Views, and both of us basically wrote, it's time to try and catch a falling knife here yesterday because things got overdone. And we've been seeing a lot of that lately. We really have. The one thing that does kind of shock me is that we haven't seen a bigger move back in the dollar with the way the euro currency has rallied. That seems a little overdone, but that's the piece. But yeah, if I was I would go long bonds back to. I think bonds are a pretty quick and easy long back to a yield, 2%, 2.05, and then things might get a little trickier.
Okay, got it. So you're thinking that this is just this pullback's a little bit overdone.
For sure. We have another trip below 2% before this rodeo's over. That's just me, though.
Got it. Because I've been short bonds, and this is kind of one where I'm at the point to where what I'm thinking is that in the near term, I could see we're a little bit overdone. I've been basically rolling down puts on TLT for the most part, just taking some profits and rolling them down. But for the time being, I could see where you're coming from. But I really think that over the course of the next couple of years, I'd rather be short than long bonds for sure.
Yeah, I mean, as a long-term play, I tend to agree, although we may see low rates. I don't think you're going to see 7% out of the 10-year anytime soon. I think you could see the 10-year move from, it settled around 218 today. I could see the 10-year moving to, close to 3% by the end of maybe 2016. That would be a win for the Federal Reserve to be able to do that. I don't see 4% is going to be pretty difficult, I think, in the next 18 months.
I could see that because I'm kind of in the low 3 camp. I think I could see it getting to like maybe between 3.1, 3.3, something along those lines. But yeah, I don't see it going to 4 either.
Yeah, I don't either.
So, all right, moving onward in the marketplace. Got some announcement coming out tomorrow. Non-fruit payroll, non-farm. Oh yeah, that. We got some volatility going into that. What are some thoughts on the VIX going into non-farm tomorrow?
I think it's going to end up being. I don't think it's going to end up being that big of a deal. I think you're going to see the VIX back off, and I think you'll probably see everything kind of handle itself. I think you're going to see the 10-year rally, and I think you're going to see the S&Ps rally tomorrow. It's never a great thing when bonds and the SPOOs correlate really well. I just think that's where we're going to be tomorrow. I think the two are somewhat going to be, they're going to probably swap with each other somewhat.
Got it. All right. Well, unless there's anything else to add to the trading block, let's get odd with it. Anything else, just Mr. Seabass?
No, I got nothing special. The Yelp deal was kind of interesting. Yelp looked like just the biggest piece of poo, and now it was up $8 today because somebody floated a rumor they might try and sell themselves. I don't see anybody paying $50 a share for it, but I do think that I would not be shocked to see them try and sell themselves. They certainly have a problem.
Yeah. I could definitely see that as well. All right. Well, that concludes today's trading block. Now, let's move right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
And welcome to the odd block today. This is the section of our show where we go through trades that just kind of make you raise an eyebrow, or as Arsenio Hall would say, or as the CNC Music Factory would say, things that make you go, We're starting off with WFM, post-earnings put sale. Shares of Whole Foods are down $4.60 to $43.07 today. Whole Foods is near the middle of a 52-week range. We have paper trading, 3,600 January 2016 38 puts at $1.80. The average daily volume is 13,793 contracts, and the open interest on that is actually 7 contracts. Volume went up in one block at the ICE. These puts were traded near the bid and were most likely closing in this particular trade with earnings out. Traders betting that Whole Foods does not drop too far below $38. Mr. Seabass, any thoughts on this Whole Foods trade?
They had really, really ugly earnings, and it was down today. So maybe somebody closing out some profits and stuff. So that's absolutely what it could be.
Got it. All right. Next we have HYG, the High Yield ETF. That's an ETF with which we've actually looked into this in the past. We're not doing anything. This is several years ago. We actually looked at this at RCM. With this, HYG is near the upper end of its 52-week range. It's up 11 cents to $90.49 today. There was actually a 10,000 lot in the July 85-88 put spread that traded for 55 cents. ADV is 27,643 contracts. Open interest on the two puts that make up the spread is around 22,000 and 29,000 respectively. Volume actually went up in 2 giant blocks marked spread. There is high open interest, and it is possible the trader is buying the put spread to close. Without a recent rally in HYG, this would be a strange time to close the put spread unless they thought more downside is coming. What are your thoughts on this? You thinking this is a bearish trade, Mr. Mark, or any ideas on what we feel is going on in the junk bond world? Or I'm sorry, the high yield world.
I know HYG. A lot of people are worried about this, the HYG and these ones. I mean, this is one that a lot of people are watching for, what is going to happen in the bond market. So this is one, if you're interested in kind of how bonds are performing and what might happen, HYG is one. And this guy's definitely a little bit scared. And I don't completely blame him. I think high yield is not that high a yield. And so, as you see some of these government rates start to increase a little bit, we could see stuff weaken up for sure.
We could. And so like right now where I'm at with some of my clientele is that we do have some exposure in some muni bonds in various states. Good gosh, not Illinois. I wouldn't wish, unless I'm really purposely trying to bankrupt my clients, I would never have them be in any muni bonds in the state of Illinois. But just in some other states that are a little bit more strong, we do have some muni bond exposure. And so with that, what we're doing in a lot of ways, we're just holding them because they're in a shorter time span. And what we're looking to do along those lines is just basically hold them until maturity in like between 3 and 5 years in a lot of cases. Mm-hmm. And at that point, if we do actually get higher rates, we'll just exchange them for higher rate bonds at that point in time, because we've analyzed it from the standpoint of the bonds are trading at somewhat of a premium now. Does it make sense to get out of them in the cases with which we have, which muni bonds are not a huge thing at RCM by any means, but in the exposure with which we do have, getting out right now at at the premium levels with which a lot of them are trading from a tax standpoint does not make a lot of sense. So that's kind of where we're at right now in the muni bond world. In terms of corporates, we have very minimal corporate exposure, not even enough to mention, quite frankly. And in terms of high yield corporate exposure, I would say maybe less than 0.1% of AUM we have with that. I am not a fan of high yield right now. I think the risk reward is just not there over the course of the next 3 to 5 years. So I think that, in my opinion, on this trade, maybe not this trade per se, but just on something like HYG, if I had a gun to my head, I mean, I'm quite the bear.
Yeah, I don't disagree with you. I'm a little bearish on this one myself.
Alibaba. We have calls trading in Alibaba, an upside call spread trader. Shares of Alibaba are up $5.59. Actually, I think they were up a little bit higher than that, but when this came out earlier today, that's what they were up. We have paper trading, 9,910 Alibaba July 100 110 call spreads at 37 cents. ADV is around 138,000 contracts, and the open interest of these two contracts is 29,000 and 23,000 contracts. Volume went up in 2 blocks on the ISE. A lot of volume going up on the ISE today. From the previous day's close, the spread is up 10 cents on the rally in Alibaba. Could be closing, so at this point the trader is not looking for any real upside in that name, but it is worth checking on open interest tomorrow. So right here we have a 100-110 call spread on Alibaba. What are some thoughts on that, Mr. Mark?
You know, Alibaba made a nasty move today after basically being in the toilet the last few weeks, and you know, hopefully that will get itself fixed up. We'll see, but for now, you know, kind of interesting what that did today. Just huge earnings move.
It did. I actually have a little bit of Alibaba. I very minimal position in this one, just as some of the more speculative section of some client portfolios, just owning the stock for this one. And I think that this is one of those stocks that is more of a buy and hold type investment for me. So today was definitely a beneficial day. I think we got in the lower to mid 90s is where our basis is on this one. We sold puts on it for a while. We're trying to get in, and well, we got our wish. And so I think that with Alibaba in general, I am bullish on it for the time being, but it still would have a long way to go to get to the 100-110 mark by July. That's for sure.
Yes, absolutely.
All right. Well, that concludes our strategy block for today. And now what we are going to get into is the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the mail block.
And welcome to the mail block. This is Mark Longo's favorite section of the show, and I actually like it quite a bit too, because this is when we get to hear from you guys, our loyal listeners, some questions with which you may have, and then we can hopefully answer them to the best of our ability and learn a little bit in the process. First question that we have is from Dmitry, and I'm not even going to try to pronounce your last name, Dmitry, because I know how many times that people murder my last name, so I'm not going to do that to you. Question from Dmitry. Where do you see more HFT activity, in equity markets or in option markets? Mr. Mark, thoughts on that?
Well, I mean, if you as a percentage of the volume, I think it's probably about the same. You know, maybe a little more in the stock market, but there's HFT rampant in both of them. So, you know, you're not getting away from it in either. And, you know, the stock market is just, you know, that is a mess if you don't know what you're doing. But options are the same. Options are absolutely the same in terms of how they react to HFT and how HFT can game them. And in fact, sometimes HFT will use a move in stock to then go and flip and slam people in the on the option markets. It's incredible the way that can work.
Well, it is, and people that have the technology to do something with HFT, they're probably going to have an understanding of how the option market works. Not all the time, obviously, but nonetheless, if you're paying the money and investing in the money to get the software to get what you need to get to be an HFT firm in some way, shape, or form, then I would think, I've never participated in any HFT by any means, but in a lot of ways, you have the ability to do both. So, all right, next question is from Tom. And Tom, I'm going to go ahead and take this one, and then I'll spin it to you, and I'll send it to you in a second, Mark. When should I adjust a credit spread? What percentage of profit should I aim for? All right. With that, the reason that I'm taking this, Tom, is because Mark Sebastian does not believe in the word credit spread for very good reason. But nonetheless, everyone has their rules for different things. I think that in terms of when you should adjust one, if you are taking a higher percentage of your portfolio, I think you need to make the adjustment a little bit sooner. So in other words, let's say that XYZ stock's at 55 and you sold the 50-45 put spread. A lot of time, if it's a higher percentage of your trading capital, then usually the general rule that I like to take is when we get up to a point to where you would lose as much as you were trying to gain. So in other words, and this can be done through Delta, you can look at a lot of different things on it, but the bottom line is this. Let's say that we get to the point to where you're down $1 in the trade and you got a $1 credit on this credit spread. As soon as I'm at that level, then I am looking to make an adjustment. I am looking to see where I went wrong, or I'm looking to get out of the trade. The reason is that if you wait too long, then a $1 credit all of a sudden becomes a $3 loss, and that takes a while to get back. So in terms of when you should adjust it, my rule is when I am losing as much as I was trying to gain. Now, when I talk about all these SPY spreads that I'll trade on the show, that's with probably 1% of the overall client portfolio in a lot of situations. In that case, maybe between 1 and 5% of it, I would say. In that case, I usually let it go until it touches the short strike price. So if XYZ was at 55, I would probably wait until it got down to the 50 level to make the adjustment. Now, the other point of that is that most of the time, if I'm trying to get that $1 credit, usually because of the fact that I'm doing usually probably 2-week spreads a lot of times, it's usually at a point to where I'm at my first rule anyway, to where I'm trying to get $1 at that stage. Usually I'm down $1 when it gets to that. So those are probably the two general rules that I have for it. And Mark's might be a little bit different, but those are the ones with which I try and do. Now, what percentage of profit should I aim for? This one's a pretty hard and fast rule for me personally. Once I have the ability to get 80% of the desired credit, I take it. So in other words, let's say I got $1 for my put credit spread or my call credit spread. Once I can get out at a limit order at 20 cents, that's when I get out. I think that if you're trying, you can debate over whether you want to go for 90% or 70%, whatever the case may be. But I'm usually around 80% is where I want to get out. If I'm at 23 cents instead of 20 cents and it's right before the close and I don't want to go overnight, I'll get out at 23 cents. And I'll leave that extra 3 cents on the table to be able to sleep at night, so to speak. But I would say 80 cents is a pretty tight rule with which I have for when to get out of a spread. Because if you're waiting for them to expire worthless, I've just seen too many winning trades turned into losing trades when that happens. Mark, whenever I'll adjust the wording of the question for your benefit. When do you adjust a short spread?
Well, I mean, I don't do a lot of adjusting of short spreads, in the traditional sense, but certainly I agree with you. I'm never willing to lose more than I'm trying to make. And the way I kind of think about it is I kind of set 2 max losses, and max loss 1 is kind of my normal max loss, and that's kind of trying not to lose any more than what I make. Adjustment 2 I like to call like my absolute max loss. And that's where in any reasonable scenario, I could never get to that number. And so I use that as a kind of, outlier move type management to risk management piece. And it really does make a big difference.
Very good. I think the main theme that we've been saying on this show for 400 episodes now is
management.
Yes, absolutely.
Question
from Fred. I am a futures guy dabbling in options. Do option traders need different tools than futures traders? If so, what tools or services do you recommend outside of the broker platforms? Well, typically, Fred, I typically use the broker platforms for what I'm looking to do. So I'm going to pass this one off to Mr. Mark.
Yeah, I mean, so there's a lot of things that you need that are different from options relative to relative to futures. Really good volatility analytics, I think, are the key. There are ones that are – some of the brokers are getting better at having volatility analytics, but they're still not all perfect. And so, and then position tracking software, stuff that can help with other pieces of stuff that can help with other pieces of other pieces of risk management, tracking positions. So there's a lot of software, I think, to really be effective. There's live vols out there. Bloomberg has good stuff. FT options. Option View's not terrible, but I don't love it. I think it's a little slow. Something like that is the stuff that I use on a day-to-day basis, along with some of the stuff that I get from my broker. Some of the different brokerage platforms are decent, but not 100% perfect.
I would agree in that. I see where you're coming from on that. From Karl, what's the better way to get free juice on a bullish position? Bullish risk reversal for a credit or even, vertical ratio call spread for a credit or even, or just a short put for a credit, obviously. This would be for a near term, meaning a few months, but not an explosive, maybe up to 5% rally in the underlying. When is buying the stock the best option? I'm going to start on this one, Mark, because I think we can go get a lot of answers on this. The first thing that I would want to emphasize, Karl, is that there is no such thing as something free. You're always going to pay for something in some way, shape, or form, and there's always a reason for which you may be able to get a credit on a bullish position in one way, shape, or form. I'm going to start with the last question in terms of when is buying the stock the best option. My opinion, for the most part, I'm more of an option buyer. I think that options, if I'm bullish on something, buy a call. If you're bearish on something, buy a put. Most of the time for me and my clients, that's usually the way with which we go. But I want to kind of go over something that has happened. I've been talking about on the show the last couple of weeks, or the last couple of months actually, and that's XLE. When oil has dropped like it did, I became an oil bull. And the way with which I was being an oil bull is just being long XLE. Now I know Longo's not on the show today. I'm just going to tell you what I really do, because he won't spin it around into me selling all these 35 puts on XLE like he always says I do, which I don't, by the way. I'm just long XLE, the underlying. And the reason is that I really don't see oil being as low as it was when I got into it towards the bottom for a lot of my clients. And so combine that with the fact that I really am not able to tell when oil is going to come back, but I also feel that oil companies will figure out ways to make profits, even if oil did stay in the 40s and the $50 range, just by shutting down some of their various rigs. So with that being said, because of the uncertainty of the when, that made me want to buy the what and not mess with anything with options, because of the fact that it just wouldn't be a winning proposition for what I was looking to do based on my sentiment. Another situation is that if you have ever listened to the show at least once before, you know that I am a bull on the metals for the long term. When silver had its rally a couple of years ago, my clients and I made money on it, and we were collaring it, and we wanted to have managed risk on it, and we made money on it for sure, but we didn't do so well relative to the performance of silver. Gold, on the other hand, we actually did very well in relative to the performance of gold for what we were able to make, combined with the fact that we were very well hedged on it. So this time around, I'm still a silver bull over the course of the long term, but this time around what I'm doing is I'm still collaring gold like I always have, But with silver, because silver has the chance to just make a ridiculously explosive move if it does what it did the first time, which who knows, maybe it will, maybe it won't. What we're doing with silver this time around is we're just owning the underlying, but we're managing risk by taking on a very small position. So in my opinion, when it's better to buy the stock or the underlying is when you have absolutely no certainty as to when the time is, and you're managing risk with either a stop loss or a smaller position. Mr. Seabass.
Yeah, I'm with you there. I don't mind selling puts here and there, but I think the key is to understand the volatility. If you match what you're trying to do to the volatility underlying, and you may decide you want to own calls, you may decide you want to own puts, you may decide you want to sell, you may decide you want to do a risk reversal. A great way to trade some of these is at the risk reversal level, where you get where you sell an out of the money put and buy an out of the money call and collect a credit on that. That could be a great trade, and that could be a way to get long and collect juice at the same time.
Definitely. All right, well, that concludes the mail block for today. And now we're going to go into the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the strategy block.
And welcome to the strategy block. Today, we have our special guest. Oh, wait, I am the special guest host, so I'm introducing myself. Today, what I want to talk to you guys about in the strategy block is selling puts. Today, one thing that I was looking to do in the marketplace after the pullback with which we've had in SPY over the course of the last week, position that I've been in for a while is I've been long the 209 calls on SPY. I recently rolled them out to September, from June to September, a few weeks back, and just stayed at the same strike price. Just rolled them out because I wanted to get, didn't want to get pounded by the theta monsters, so to speak. And the other call with which I was short, I sold the May 213 call, and the reason with which I did that was because we were towards the higher end of a range, and I gave myself some leeway, so to speak, of us going higher. It was not one of my preferred trades, but it ended up working out. A couple days ago, took profits on the 213 call for May, and going into yesterday, what I was looking to do, going into today, what I was looking to do is possibly sell a put spread as a means of financing the September 209 call. The whole point of what I try and do is I want to basically make the cost of that 209 call as little as possible, have bullish exposure, make the cost of that 209 call as little as possible by either selling put spreads, doing calendars, selling short calls, whatever the case may be. And today, what I was looking to do and hoping to do that I didn't get to do was sell a put spread. I was hoping for a down day today, actually. We opened the day on SPY around the 208 level approximately. And so we closed the day around just under the 209 level. And so what I was hoping would happen today is that if we had another down day today, what that would do is give me the ability to sell a put at a lower price. I'm a believer in buy low, sell high, or buy high, sell high, or I don't know, whatever works. But nonetheless, for selling puts, what I like to do is sell them on down days. So to give you an idea of it, we go into the week, we closed on Friday at 210.83. And so going into the week, we had an up day on Monday, down day Tuesday, down day Wednesday. And then if we were to have another down day today, my thought would be that, okay, we've had several down days in a row. Number one, that could be an overreaction. But number two, we'll likely have higher volatility. If we have higher volatility, that'll give me more premium on the puts. And if we have a down day, that gives me the ability to, quote unquote, buy the dip. Me being the eternal bull with which I am, buying the dip is a very fun thing to do. But unfortunately, I didn't quite get the dip I was looking for today, so I did nothing. I'm not a fan of selling puts going into an announcement like we have tomorrow, but if we would have had enough down days and enough volatility to justify it, I really felt that I could have sold something maybe around the 207, 208, the 207, 206 level over the course of a week or two. Who knows? But when I saw the green on the screen today, I realized that today was not going to be my day. So we'll have to wait for another opportunity. Here's the lesson in this, folks. I've talked about selling puts on dips and how I feel it can be very beneficial if you're a bull because of the way volatility reacts, as well as the fact that if you're bullish, buying on a dip is a good thing if you're bullish. But the second thing that I want to really say for today is if you don't see a trade and the trade doesn't give you what you need, don't just trade for the sake of trading. I had a client today call me saying, well, what if we do this? What if we do that? What if we do this, this, and this? I'm like, you never trade this way. And right now his account is probably 97% in cash. And it's a very large sized account. And so, just after talking, he's actually a very good client. But just after talking, we had spoken about it. He just kind of made the concession. He's like, well, I'm not going to trade just to trade. So that's where we left it. So the lesson today, don't trade just to trade. Wait until your rules allow you to do so in an effective way. And that is the strategy block for today. Next, we have Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Mr. Sebastian, what are you looking at around the block?
Well, we've got non-farm payrolls tomorrow. I don't know if you heard, but, I'm looking for a stabilization in rates out of this. Looking for probably the smart money is to maybe buy some German bunds here. And I could see kind of a reversal in this interest rate move. I still think the dollars sell-off has been a little overdone. I could see it rallying, and a few more earnings here and there, but really it's all non-farm payrolls.
That is the same thing that I am seeing on my end. So with that, what's going on in the option pit?
Well, we're going to be doing a boot camp in June, and for our past graduates, we're doing a special get-together in July. You can go to optionpit.com/events. If you're a former student, you're welcome. Go to optionpit.com/events, and of course, read our blog. optionpit.com/blog.
Very good, very good. And that concludes today's episode of the Option Block. We'd like to thank everyone for coming, wish everybody well, and let's have a successful trading day tomorrow. Goodbye, everybody.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.